But you are saying that despite the increase in FX liquidity, there's still the possibility of that mismatch in terms of the tenor of the FX sold. Talk to us about that.
Okay, right. This is about, okay, as you know, the central bank sells almost the whole of the FX that they sell today to the market. They sell everything forward. So you see mismatches between the maturity of the forwards and the maturity of the trades that the forwards are meant to pay, to settle. Okay. So where that leaves you is that you have to find ways of closing those gaps. 15 days, 30 days, whatever it is that the gap is, you find ways of closing that. And that, while there are options, that tends to increase transaction cost because it's something that banks will have to do at a cost, definitely. I mean, for a fee and clients pay. And that talks to the fact that we are at a new normal. Before, you could buy and the FX is settled spot and you pay. But today, you buy forward and then the underlying financial instrument that settles the trade also matures around that time, and then trying to match two of them off, it's a bit of something that we have to deal with.
How often would you say this occurs? I mean, the fact that, I mean, if we see, the forwards and we have the mismatch, and of course that you said that could lead to higher transaction costs. Does it occur frequently?
Yeah, it's something that is it's a bit frequent, but because the gaps are not wide, and because you have, we've seen increase in FCY liquidity, okay, then banks are able to deal with it. So the cost we are talking about is marginal, but at the end of the day, because of the large volume, it counts for something.
So one of the recent developments in FX and trade is that the UK has announced that it will start accepting Nigerian payments, like that's the Naira, for UK exports. How do you think this could impact Nigeria, the trade environment in Nigeria?
Well, yes, it is essentially an initiative to push export out of the UK to Nigeria, essentially. All export credit agencies have programs like that. But what makes this one special, what makes it different rather, is that their intention is to issue guarantees in Naira, to de-risk transactions and then allow Nigerian banks to lend to importers, for the same purpose, for the purpose of pushing export out of the UK to Nigeria. So will it help? Yeah, we will see. We will see, because how it's implemented is what will determine how it eventually settles. If, for instance, it's just insurance, and then it's about de-risking it, we'll need to wait and see how that affects the final price of the loans.
I was going to ask you, don't you see opportunity there? Can't a Nigerian bank also de-risk the transaction?
Well, the Nigerian banks try to do whatever they need to do to lend to people, and you see the right level of risk before you lend. But what makes this different is that it's the insurance of the UK government. So in terms of the rating of the UK government, that's very high up there, and therefore when they step in and stand behind the party you are lending to, the risk will come down significantly. I get a sense that you don't think that it also benefits the Nigerian businessman who's also importing some of those goods. Doesn't that protect him from foreign exchange fluctuation? No, it benefits Nigerian importers definitely, okay, because the key thing there is to remove the exchange rate risk, which he will be exposed to if he's doing any trades 2 years upwards, which is. But it's all short term, anyways. No. This program is going to target 2 years upwards, which makes the exchange rate risk significant, and therefore it's going to benefit both parties. It's going to be beneficial to everybody before it can work. Okay, I've asked that because you don't appear to be excited about it. I was just thinking, if it protects, I know it's primarily pushing goods down here to Nigeria. We don't know, how, if there's a balance in terms of commensurate, but I'm just thinking. No, it's going to create value, and it's going to appropriate value. So, I'm excited about it. Maybe I didn't show it. But we have to buy because we find value in buying from that. So it's going to benefit us. Yeah.
So something I find interesting is that FX sales have come down from about $65 billion in 2014 to about $15 billion last year. And I was just wondering, What led to this? Like, what's driving this?
It's prudent management. You know, it's prudent management because you have to think of, okay, well, there more than prudent management. We had the crash of the commodity prices, you know, refined petroleum products and the like. You know, the prices came down, so the value of a full cargo came down with it. So even though you did the same volume, the cost was lower. And then secondly, the list of 41, and then the tightening, you know, of exchange controls around let's import only those things that we really need. Rice, you don't import anymore because we're able to meet our needs and all that. So that's what has forced the demand down to the level you see today. Because really, that is what is squarely under the control of within the control of the central bank. We can control demand.
So the FX reserves are up to $42 billion. That's something the government is clearly very happy about. Do you think that there's a risk that we'll start importing as much as we were back then again, just because we have this cushion, seemingly?
Well, I don't think so. I don't think so. Or let me say, I don't hope we do that. I don't hope we do that, because really what will help us benefit from the pains we took over the last 2 years, make use of the lessons we've learned over the last 2 years, is just to keep to the prudence that we stuck to.
Yeah, absolutely. I don't think the central bank governor is going to let that happen. I mean, getting to where we are now with the reserves currently around at $42 billion, I don't think that obviously that's going to happen. But thank you so much, Chidi.